All right, so now we're going to talk about those purchase discounts. We talked about this in the last chapter, but we were talking about it from the standpoint of the seller. So now we're talking about the buyer. And I have everything filled out because we've seen this before. I'm going to walk through it. We purchased $1,000 of merchandise, 210 and 30, which means a 2% discount if paid within 10 days. Otherwise, the full amount is in 30. So in this case, then not the periodic method, we're doing the perpetual method. Under this case, we have the gross method on the left, the net method on the right. When the purchase is made, notice, of course, under the gross method, remember the assumption is we are not going to pay within the discount. So we record the full price. Under the net method, we take 2% off the full price because we assume we are going to pay within the discount. So if we do pay within that discount, we're going to end up paying 980, which is what we record to inventory and accounts payable under the net method. Now, if we do act within the discount, we have violated our assumption under the gross method. We're not going to pay full price. We only pay 980. The $20 goes to the discount. And because that inventory is being bought with $980 of cash, it should not be $1,000 in the inventory account. It should be 980. Well, a debit of 1,000 and a credit of 20 will get me the 980 that I actually paid for this inventory. The accounts payable is originally recorded at 1,000, right? But so we have to debit it at that amount, but we didn't actually pay the full amount in cash. That's why we have to have that $20 credit to inventory, which balances our accounting here in this particular entry with debits and credits. But it also then, as I mentioned, brings inventory down to the right valuation. Under the net method, if we act within the discount, then there is no issue. We pay just as much as we thought we were going to pay, and there's no need for the discount account because the discount has already been put into place at the purchase, right? So purchase versus payment. Now, if we do not pay within the discount period, then hey, we guessed it right, right? We assumed correctly under the gross method. There's no discount. We're going to pay $1,000 for this inventory. We do not have to adjust the inventory account by a discount because no discount was taken. We pay $1,000 of cash, that cancels out the payable. If we do not pay in the net method, we have an issue because we thought this inventory was going to be 980 because we were going to take a discount, but we actually paid outside the discount, got to pay full price, got to pay $1,000. If we pay $1,000, the problem becomes, well, we only recorded the account payable at $980. So we keep that at 980, get rid of it all, but then we give ourselves a little bit of interest expense. So this interest expense, just like the interest revenue under the seller side of things, is substitutable or synonymous with purchase discounts forfeited. Purchase discounts forfeited. Both of these accounts, when debited, reduce net income. They have nothing to do with assets. They do not belong in our inventory valuation. If you recall, this is something that's not included in the value of inventory. So when we lose a discount, we do not increase the value of our inventory, which is a little strange because we paid 1,000 for it, right? It's not like over here in the gross method where the asset is stated at the cost. Here, the inventory stays at 980. And rather than show that, we instead include an interest expense item or a purchase discounts forfeited, which is doing the same thing. Right. So let's go back to that example here where the Kyle example. If you recall, we had really the account when you are dealing with payment. that you want to look at is the account payable account. So we established the account payable at 120. We knocked $1,400 off because we made a return. So that 120, I'm just going to do a T account for this guy. So it was at 120,000 when we made the purchase. We made the return for 1,400, which brought me down, if I apply that, to $118,600. That's how much payable I still have to pay off. And that's a starting point for me when I'm working these. So now recording it under the gross method. If this is a gross method number, that means that this is 100% of the total price. If I pay within the 10 days, then I do not have to pay that full price of the payable. Right? That's 100%, but I acted within the discount. I get a 3% discount. So 3% of $118,600 is $3,558. So that's just the 3% multiplied by the full price. Oop. Sorry, I'm doing a periodic entry there, inventory. So we credit my inventory account for, it's a little off, 3,558, and I pay the rest in cash. The remaining 97% would be paid in cash. So that's going to come out to 115,042. And of course, a credit to inventory drops my inventory, a credit to cash drops my cash, a debit to liability reduces liabilities. Now, under the net method, this $118,600 would be considered net of discount. So this account payable, because it would have been recorded net of discount, is actually 97% of the full price. So to convert it into a full price, I take that 97% number, 118,600, divided by 97%. And it doesn't come out clean, but I will round $122,268. That's the amount of cash I would have to pay in order to get rid of this payable that was recorded at the 97% price, because we're doing the net method. And the payable, remember, is always expressed either gross full price under the gross method or net price net of discount under the net method. The debit that links them would be my purchase discounts forfeited, or if you will, interest expense, either is accepted. And the difference between those two is $668. Okay. And remember again, this purchase discount's forfeited, that debit to that account reduces net income. The debit to accounts payable reduces the liability, and the credit to cash reduces my assets. Right, so that's the cash discount piece of it, and paying the actual payment of inventory on credit. Now we can move into cost flow assumptions. Cost flow assumptions, again, are covered in intro, a bit of a brush up on these guys. Remember that first, they're assumptions. Okay. This is not actually how things are flowing in our place of business. We just have to assign a price to the things we sell, and we buy things at various prices over time. So should I choose the oldest prices, the newest prices? Should I choose something as of an average between them, right? Each of those scenarios is covered here. Things, under all of these, the purchase accounting doesn't change. So everything we just talked about to this point, that doesn't change. What changes is what I would record in cost of goods sold, and the credit would be to the inventory account. The quantity of items that I'm selling, the quantity of items I have, same, right? All we're changing is the dollar value on a particular quantity. So the head count doesn't change, right? No magic going on here. Really where the difference arises is, what do I price my inventory at, and what do I price my cost of goods sold at? So it affects what's going into cost of goods sold versus what's going on in inventory. So what prices land in these two accounts? All right, so the specific identification. Oh, and then finally, the one thing that I didn't talk about, but I sort of alluded to with the word assumption, these don't necessarily have to follow the physical flow of goods, right? The only requirement that GAAP has of these is that we apply rational and systematic processes. So systematic meaning same time every time, and that they can be based on rational amounts, right? We bought them at $6, then we bought them at $8. I'm not going to put a cost of goods sold of $100. That would not be rational. All right, specific identification. This is where we have a small, costly, distinctive items being sold, where we can say we sold serial number 1256 on January 3rd. And 1256 serial number cost me $123.63, right? If we can identify our inventory at that microscopic level, then the cost of goods sold doesn't have to be an assumption, right? It is specifically identified. This is not a very commonly used approach, because there are too many businesses that are in the whose operations encompass selling homogeneous items that are indistinguishable from the next, right? So not commonly used, but in very niche sort of stores, artisanal jewelers, right? Or gun sales. Hey, we're in Texas. Those items are distinctive. They're separately tracked, carefully inventoried. We can apply the specific cost to cost of goods sold when we sell that piece of inventory. The other three are the assumptions, right? We can assume that really, I'm going to go to these two first, and that's the happy medium. First in, first out. We can assume that we sold the goods in the order we purchased them. So the oldest purchases, the things I bought months and months and months ago, maybe years ago, were the things I sold first. An interesting aspect of these is that under both the periodic and the perpetual method, cost of goods sold is the same with first in, first out. That is not true of the other methods. Um, but if you want to think about first in, first out, think of a grocery store. Grocers intentionally stock items so that consumers will buy the oldest stuff first. That's why I remember as a kid, don't drink milk anymore. But when my mom would buy milk, she'd be reaching far back, and then she'd be like, "Bill, you got long arms. Reach back there and grab that fresh milk, the stuff that just came in. You got to go all the way back there, right? Because they stock it so that you're just going to grab the first one off the shelf, the first one off the shelf is going to be the oldest stuff that they got in. A bakery, same idea. They're not going to push out, they're not going to want to keep the cookies that they baked at 6 a.m. this morning until closing time. They're going to try to offload those on the first consumer that comes in the store. That way they get the freshest goods out to their customers. So those are real life first in, first out. But remember, any business can choose first in, first out. Last in, first out, the exact polar opposite. That assumes that the most recently purchased goods are the things my business is selling first. So the things that are getting offloaded from the freight truck that just pulled into our dock, right? They're unloading those things. That is my most recent purchase, right? Um, in terms of thinking of a real life flow of these, you could think of, something perhaps along the lines of a tech store, right? The latest iPhone comes out and hey, everyone's going to buy that one. They're typically not going to buy the other one. So they're buying the most recently arrived items. Perhaps a better one, a more common one would be like a hardware store. If you think about how they rack items like nails on one of those racks at the store, well, when they're bringing stuff out from the back, the things they just purchased and restocking the shelves, they're just going to put it on the end of the rack and the consumer is going to come and pull one off. Well, that's the most recent item. Okay, so basically just our most recent purchase, whatever that was, that determines the cost that goes into the inventory we just sold. So those are the two extremes. The average cost method, right, as you might intuit, takes the average of all the prices we've had during the period. And then when we're talking about perpetual method, it's a moving average. Every time we make a purchase or every time we have a new sale, we have to take an average of the purchases that have happened up to that point. So the average keeps changing over time. So this is a table that just gives you, it's a purchase sale log. You'll get used to kind of seeing the data presented this way. I have the beginning inventory. I have purchases over time. The purchases have some returns in them. They have some discount accounting going on. The sales, right, are just indicating when we have a sale so that we know how we have to or when to calculate and report cost of goods sold. It says that on January 31st, 2016, a physical inventory account was taken and there was 450 units left on hand. So this is going to be important for us to check when we're thinking about shrinkage, right? Because we're using the perpetual method, we can record shrinkage. So we need to think about, does that number coincide with the reality of my purchases and sales? There is a freight in fee of 50 cents per unit, and we are reimbursed with return units, the freight, and the returns are made prior to a cash payment, right? So it makes sense. We pay freight to get the item. Once we get the item, we decide whether we're going to return it before we pay. If we return it, we get reimbursed freight. Let's check about the shrinkage part. So if we look at this purchase and sell log, we see the number of units that were purchased and then the sales, of course. One thing we have to keep in mind with these purchases is if we purchased 1,100 but returned 70, right? then we have to take that into consideration as well. So we started off with 200 units. That's my beginning inventory, 200 units. Then we bought 1100, but we returned 70. So since we returned 70, we got that from the 1.8. That's the now that we actually kept. And this is my beginning inventory. Then we sold 1,000. Then we purchased another 350, but we returned 20. So we add 330. Bought 400, returned none of them. And then finally we sold 500. So going through that math, you should get 460 units. That's how many should be there. But we have 450 units per our count. Which implies that 10 units are missing. So we don't have a match between what we should have and what we actually counted. Therefore, we have some shrinkage. And we'll talk about how to handle that shrinkage with each of the cost flow assumptions that we have, right? Another thing, just to kind of orient you with this table a little bit, I give you the price per unit. Depending on the type of problem, depending on how many calculations there are, sometimes I'll give you a price per unit where I include all the discount and freight in it. Sometimes you just have to figure that out. So be conversant. If I give it to you, roll with it. If I don't know how to calculate it, not hard to calculate. For example, here I got a purchase price of $8. And if I get a discount of 2%, then I'm going to multiply it by 98%. So that will give me, right, the price net of the discount. Since I'm taking 2% off $8, I can just take 98% of it to get that amount directly. And then I'm going to add the freight. And that's all that we're doing here to get the price per unit in this case of $8.34. So just be sure you try it, and that you can do it with these other ones. Check your math, make sure that you're doing it right, order of operations and whatnot. FIFO perpetual. Let's look into that. These guys are just some reminders of things that I said before. We're going to use the gross method, but doesn't not really problematic in terms of how that changes anything here. So we got FIFO perpetual. FIFO perpetual says the oldest things are the first things sold. So when I do perpetual system accounting, I queue up the date of the entry. So we're at 1110. Not 1110, 110. And we have 1,000 units sold. Well, the first thing that I can record is if it's a credit sale, as indicated, a debit to accounts receivable, and a credit to sales revenue. 1,000 units, $20 per unit, that's $20,000. Now, because we recorded the revenue and the sale, we're using the perpetual method. We have to now absolutely record cost of goods sold along with this. So my cost of goods sold, it's a very simple entry. The only thing that can be problematic really here is determining how much cost of goods sold should be. So in order to calculate that, I think I've sold 1,000 units. Which units did I sell? Well, if I'm stopping here at the sale, there's only two options. I either sold the 1/8 purchase first or the beginning inventory first. Which one? Well, because I'm using FIFO, I assume that I sold the oldest first. That's what I started with. So 200 of those 1,000 are going to be at $7 each. So that leaves 800 more that I have to account for. And I'm going to pull those 800 from this layer right here, $8.43 each. And if I do the math on those, the first comes out to $1,400 and the next comes out to 6,672. Okay, rounding to the nearest dollar. That gives me 8,072. This is the total cost of goods sold for all 1,000 units, right? 200 and 800. I ascribed costs to each part of that. And I have $8,072 cost of goods sold. Cost of goods sold reduces net income. It's an expense, the largest operating expense of a lot of companies. All right. So that's the 110 sale. Now we're going to go to the January 30th sale. So on January 30th, according to the table, I sold 500 units. And those 500 units were again sold for $20 each. So I can make the account receivable entry, record sales revenue. That's going to be for $10,000. That's the easier one. Now I have to decide, well, what was the cost of those 10,000? And how much did that reduce my inventory by? And of course, cost of goods sold, no matter what number it is, will reduce my net income, and a credit to inventory will reduce my assets. So now the 500 units sold down here, remember I'm using first in, first out. So I still go all the way back to the top, except I don't have 1,100 here anymore. I already said I sold 800 of those. And I don't even have 1,100 because I returned 70. It wasn't an issue here with the 800 because I didn't bump into that issue, but I really only have 1,030 units after I consider returns. So if I've sold 800 of the 1,030, I have 230 left at that price point, right? Only have 1,030 here after I consider my returns. I sold 800 according to FIFO on 110. So 1,030 less 800 leaves me with 230. So now this layer is gone. Then if I'm going by FIFO, I go to the next oldest layer, which should be this January 25th. And that's at $9.23. So I've already gotten, go ahead and write that down, $9.23. I've already gotten the cost of 230 of my 500. I now just need 270 more units to be priced. Then I have the full 500 between these two amounts. Doing the math here, this comes out to 1,918. 1,918. I put too many ones there. And 20 cents. And this one comes out to $2,492 and 10 cents. So adding those two up gives me $4,410.30. Now, that would be the amount I would put into this entry on this date. Sorry, that kind of bled together, those two fours. $4,410.30. So those are the entries I would make on the two separate days. If I was thinking about the total cost of goods sold, then I would just add the 8,072 with the 44,1030. I add those together. Nothing carries over. 12, 4, 8, 2, 30. $12,482.30. Now, my ending inventory, right? You can go about it a couple of ways. It's pretty easy to do FIFO by just saying, oh, I still have these 400 at 1030, and I only took 270 of these 350. So there's 80 left, 80 times that. That gives me my ending inventory. But you have to consider that it's not always going to be that easy. There's going to be more layers, there's going to be more stuff to deal with. So one way to do it that simplifies it is to go back to this idea here, right? If we just look at this equation from the periodic system, just take this piece of it, right? Goods available for sale less ending inventory equals cost of goods sold. I can rearrange this algebraically. And then in order to serve my purpose, because I already have COGS, and I'm looking for ending inventory, and this pen should not be running out. It is almost brand new. All right. Go to a different color. So we have COGS, right? We got 12,482. So that's taken care of, right? What we need is gaffs. So we can get gaffs pretty easily from this table. We just got to be a little bit careful with making sure we consider returns. So in order to calculate goods available for sale, remember goods available for sale, going back to this nifty little equation, is going to be my beginning inventory plus net purchases. So we do have to consider our beginning inventory. $7 times 200 is $1,400. Done. We do have to consider discounts and freight, which are embedded in this price, and also returns. So we're going to take 1,030. Where can I put that math? This might not have been the best place to write it in retrospect. 1,030. I'll just make sure you see the math up here and then write the number down below times 834. Here we're going to do 330 times 923 because we returned 20. And here we didn't return any, so I take the full 400 and multiply it by $10.30. So I take all of these, the products of these, and we get $8,590.20 for the first calculation, $3,045.90 for the second, and then $4,120 for the third. So we're just going to go ahead and put these down here next to the layers that they're associated with. All right. And then we add them all up. And if we add all those up, we get $17,156.10. This is my goods available for sale. Now, if we have that number, 17,156 less our calculation for COGS. Sorry, I was down here just writing that out. $12,482.30. Then that can give me the ending inventory. And in this case, it would become $4,673.80. So that should be but remember, this is my ending inventory based on the purchases and sales that I recorded. It's not based on the actual count of goods. And we recognize that, hey, we should have had 460 units. So really, this 460 is what represents this dollar value. So this is really the ending inventory prior to shrinkage. So prior to an adjustment. So if we're missing 10 units, right? We said there should be 460. We did a physical count of 450. 10 units are missing. That's my shrinkage. Then again, we have to make a price. We have to assign a price to it. Use your cost flow assumption. If we're assuming that the oldest things were sold first, then you need to ascribe whatever the oldest cost is here that's still available. The 200 isn't available. We sold through those. We already assumed that in cost of goods sold. The 1,030 also already assumed to be cost of goods sold. We did not put all of this into cost of goods sold, however. We only took 270. There is 350 in total. So the shrinkage for that, those 10 units, would be at this price point where there's still units available and it's still an older price point than our most recent purchase. So we would record a loss on inventory shrinkage. And a credit to inventory for $92.30, which would just reduce this balance of $46.73.80 by that amount. So that's how you deal with shrinkage in a cost flow assumption. Ascribe the cost of whatever unit that's still remaining while considering what cost flow assumption you're using. In this case, we only had units remaining in these two layers. And between the two, this was the older cost. So we put 923 on those 10 units.